The United States swung into $576 million trade surplus with Nigeria in the first half of 2025, reversing a deficit of $779 million in the same period of 2024. Welcome to Business Points, where we extract the Nigerian economy and the government policies. I am Kike Lomo Okeri. Fresh data from the U.S. Census Bureau and the Bureau of Economic Analysis reveals that stronger American exports into Nigeria and weaker Nigerian shipments to U.S. powered the reversal. This marks a significant turnaround in U.S.-Nigerian trade relations, driven largely by higher American exports in the Nigerian market and a moderation in imports and Africa's biggest crude exporter. The turnaround in U.S.-Nigerian trade is striking. Between January and June 2025, U.S. exports to Nigeria rose by 41% year-on-year, climbing from $2.36 billion in the first half of 2024 to $3.34 billion in the first half of 2025. Imports improved in the opposite direction, falling to 12% from $3.14 billion to $2.76 billion. This swing of the more than $1.3 billion transformed Nigeria from a deficit position to a net surplus partner for Washington. The June monthly figure highlights the sharpness of this shift. U.S. exports to Nigeria surged to $919 million, up to 196% from $310 million in June 2024. Imports grew more modestly, up to 29% from $493 million to $639 million in the same period. Consequently, the monthly balance flipped from a $182 million deficit in June 2024 to a $280 million surplus in June 2025. Behind the trend is Nigerian growing reliance on U.S. manufactured goods, ranging from machinery and vehicles to pharmaceutical, at a time when foreign exchange scarcity continues to choke local production. The continent as a whole still posted a deficit of $3.69 billion against the U.S. in the first half of 2025, slightly worse than the $3.61 billion deficit in the same period of 2024, while American exports to Africa jumped to 29% from $15.2 billion in the first half of 2024 to $19.7 billion in the first half of 2025. Imports rose even faster. They increased by 24% from $18.9 billion to $23.4 billion, outspacing exports in the absolute term and maintaining Africa as a ninth string on U.S. trade book. The shift in Nigeria's balance therefore stands out. Only Egypt and Nigeria gave Washington surplus in 2025, together contributing over $3.3 billion in positive balance. However, these gains were not enough to offset deep deficit elsewhere, especially with South Africa and Algeria. The regional picture suggests that while U.S. goods are penetrating African markets more effectively, the continent's commodity exports still outweigh U.S. shipments. Comparing Nigerian performance to its African peer reveals divergent outcomes. Egypt posted the largest African surplus for the U.S. at $2.73 billion in the first half of 2025, more than doubling the $1.31 billion surplus in 2024. U.S. exports to Egypt grew by 63% from 2.55 billion naira to 4.16 billion naira, while imports rose only by 15% from 1.24 billion naira to 1.43 billion naira, tilting the balance heavily in Washington's favor. South Africa moved in the opposite direction. America deficit with the countries almost double, widening from $3.38 billion in the first half of 2024 to $6.32 billion in the first half of 2025. Imported surged by 52% from 6.24 billion naira to 9.50 billion naira, while exports inched up only by 11% from $2.86 billion to $3.18 billion. This imbalance makes South Africa Washington's most challenging Africa trade partner. Algeria remained negative but slightly improved narrowly its deficit from $844 million in 2024 to $571 million in 2025, largely due to modest rise in the U.S. export and a drop in imports. Meanwhile, the other Africa category reversed a $77 million surplus in 2024 to $108 million deficit this year. The shift in America trade balance with Nigeria comes against the backdrop of new U.S. tariff measures on Africa partner. Beginning from August 7, 2025, Washington implemented reciprocal tariff under a reversed schedule that sets Nigeria country rate at 15%, while Nigeria previously faced a 14% tariff under April Liberation Day. The reverse rate formalized the adjustments. South Africa and Algeria were each assigned 30%, while Egypt remained at 10% baseline. With qualifying industrial zone exports still enjoying duty-free access, this tariff add to existing most favored country duties and designed to mirror restriction faced by U.S. goods in the affected market. The move has been heightening pressure on resource-driven exporters like Nigeria, Algeria, while widening American imbalance with South Africa in metal and autos. By contrast, Egypt's position has been more resilient as its diversified exports and quiz framework insulated key sector from the steepest tariff impacts. Oil producing states reduced the domestic debt burden by about 610.84 billion naira between June 2023 and March 2025, as they received a record inflow of about 13% derivation fund. The analysis is based on the most recent subnational domestic debt report from the Debt Management Office, as the figure for the second quarter of 2025 have not yet been published. In June 2023, the combined domestic debt of the 9 oil-producing states stood at 1.66 trillion naira, representing 28.6% of the country's total subnational debt of 5.82 trillion naira. By March 2025, the collective debt had fallen to 1.05 trillion naira, accounting for 27.2% of Nigerian total state level debt of 3.87 trillion naira. Delta State, traditionally one of the largest recipients of the derivation, cut its domestic debt from 465.40 billion naira in June 2023 to 204.72 billion naira in March 2025, a decline of over 55%. Akwa Ibom also reduced its loan by more than 40%, dropping from 199.58 billion naira to 118.21 billion naira in the same period. Bayelsa, another top derivation earner, brought its debt down from 134.50 billion naira to 73.53 billion naira, while Imo State reduced from 220.83 billion naira to 122.09 billion naira. Edo, Anambra, and Abia and Ondo also posted decline, with Oando cutting the sharpest, proportional from 73.03 billion naira to just 11.76 billion naira. Rivers State, however, bucked the trend as the only oil-producing state to record an increase in domestic debt. Its obligation rose from 225.5 billion naira in June 2023 to 364.39 billion naira by March 2025, an expansion of more than 60%. The state's rising debt profile contrasts with broader pattern among its peers, even as it remained one of the top recipients of derivation allocation in the period. The revenue picture from the state budget implementation report also highlights the width of the debt repayment on oil producing states within the same period. Available record shows that 9 oil states generated a combined 1.39 trillion naira as an internal generated revenue between the third quarter of 2023 and the first half of 2025, when set against the 610.84 billion naira in domestic debt repayment recorded between June 2023 and March 2025. It means that closer to 44% of the internal generated revenue of these states were effectively absorbed by loan repayments within the period. The proportion shows how much of the state's owing earnings were channeled into reducing debt rather than financing new projects. It also observed that percentage could be higher once the Debt Management Office released figures for the second quarter of 2025. A closer look at the IGR number shows that Rivers State reported the highest inflow at 507.23 billion naira, followed by Delta with 250.36 billion naira, Akwa Ibom with 136.81 billion naira, Edo with 132.51 billion naira, and Bayelsa with 101.85 billion naira. At the lower end, Oando generated 68.83 billion naira, Abia with 69.87 billion naira, Imo State 47.51 billion naira, and Anambra with 73.04 billion naira. Bayelsa and Edo had no figure published for the third quarter of 2023, while River and Anambra had yet to release the IGR report for the first half of 2025. The absence of these data points means the actual combined IGR of the oil producing states is higher than the 1.39 trillion naira currently available, which in turn implies that the share of revenue consumed by debt repayments may be lower than the present estimate of 44%. Even with the gaps, the figure highlights a structural challenge while derivation allocation delivered record inflow to these states. Their own revenue mobilization remains weak compared with the physical needs for smaller producers such as Abia, Imo, and Ondo. The size of their debt repayment relatively to their report IGR shows how dependent they remain on federal shared oil income rather than their own tax base. According to the report, oil producing states in Nigeria receive a total of 1.67 trillion naira as 13% derivation allocation within 2-year period covering July 2023 to June 2025. This is according to the data released by the National Bureau of Statistics based on Federal Account Allocation Committee disbursements report. The figure reveals a sharp rise in allocation over the period, with the first half of 2025 alone accounting for 40% of the entire sum. The derivation principle guaranteed that 13% of oil revenue earned from natural resources produced in a state is a set aside for the state. For decades, it has been both a physical lifeline and source of contention in the politics and resource control. Additional 900 billion naira capital is expected to be injected into the Nigerian banking industry before the end of 2025. Although the expiration of the regulatory forbearance will moderate the performance of the bank, a report by Augusto and Co. Limited, in its Nigeria banking industry report, the firm noted that The banking industry has remained resilient, successfully navigating various global and domestic macroeconomic vagaries. The report reveals that the industry has maintained an upward growth trajectory, with the total assets and contingent projected to reach 242.3 trillion naira. That is $151.4 billion at the rate of 1,600 naira per dollar by December 31st, 2025, after expanding by 44.9% year-on-year to 186.6 trillion naira. That is $121.5 billion at the rate of 1,536 naira to a dollar as of December 2024. Notwithstanding the funding pressure from the prevailing high interest rate environment and the contractionary stance of the monetary authority, and the industry remained liquid with a 59.49% in the fiscal year of 2023, which is 43.5% liquid ratio. Augusto further said it is believed that the liquidity ratio will exceed 60% by full year end 2025, supported by favorably albeit declining yields on treasury securities. The report also reveals that 1.7 trillion naira was raised by 16 banks in 2024. It stated that the introduction of the new minimum paid up capital in March 2024 drove recapitalization activities in the industry. Although the minimum paid up capital directive will not be effective until March 31st, 2026, about 1.7 trillion naira was raised by 16 banks in 2024. Similarly, 800 billion naira was raised in the first 7 months of 2025. Thus, 8 banks have complied with the minimum paid up capital directive as at July 31st, 2025, ahead of the 31st of March 2026 deadline. The firm anticipates the injection of additional 900 billion naira as a significant number of banks strive to comply with the minimum capital directive before December 31, 2025, thus providing additional capital buffer for current business and near-term growth plans. All right, let's take a quick short break. We'll be right back. Don't go anywhere. Stay with us. Welcome back. If you're just joining us, it's Business Point on Global Television, where we extract the Nigerian economy and the government's policies. The Nigerian Customs Service Apapa Area Command has announced a collection of 161 billion naira in revenue within 3 weeks via the Unified Customs Management System, also known as Bodogu. The Custom Area Controller in charge of command, Babatunde Olomu, disclosed this during a recent stakeholders engagement at the command. According to a statement released by the command, Olomu maintained that there are prospects of improvement in Bodogu's system, even as he commended the stakeholders for their patience and understanding. Between August 1 and 22, 2025, the command collected 161 billion naira using the Bodogu system. He expressed optimism in the capability of the Bodogu platform to facilitate more trade than previous ICT system, thereby deployed by the NCS, adding that stakeholders' patience will not be in vain. The Apapa Custom Boss reiterated that the dedicated ICT department of the service has been working round the clock to achieve a permanent solution to the impasse, describing the command as a critical and strategic area for the realization of the NCS goals. Olomu says the Comptroller General of Customs, Adewale Adeni, has initiated and sustained dialogue with Executive Secretary of the Nigerian Shapers Council with a view to ameliorate the effects of recent downtime experienced in the course of their transaction. 45 out of 146 companies listed on the Nigerian Exchange Limited have not paid dividend in the last 5 years. That means roughly 1 in every 3 quoted firm has withheld cash reward from the shareholder over the period, according to analysis. Dividends are the portion of the company's profit distributed to shareholders, serving as one of the few reliable ways investors can earn a steady stream of income from the stock market. Regular payments also a marker of financial strength, since they are drawn from their current profits or retained earning, and signal management's commitment to rewarding shareholders. For income-focused investors, a company dividend history is often as important as it is growth prospect. Still a decision not to pay dividend does not always mean a company is in distress. Growth stage firm, for example, tends to invest profit into expansion or acquisition rather than distribute them as cash. The companies that have not paid dividend cut across various sectors, from consumer goods and ICT, industrial goods and healthcare. Alright, this is where we draw the curtain on Business Point today. Join me again tomorrow on Global Television on DSTV channel 365 and Start Time channel 276. To stay connected, kindly follow us on all our social media platforms. Till I come your way again, I am Kike Lomo Okewi. I celebrate you all.